My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other way, friends, I'm just trying to make a little money. My job is not just to entertain, but to educate, coach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. What, are we out of money? Don't the mutual funds have enough cash? Hey, that's my reaction to this action. After a day when the Dow advanced 65 points, S&P dipped 0.32%, but the Nasdaq lost 0.85%. With the latter becoming an annoying source of funds for everything else. Right now, at this very moment, mutual funds know that they have to pivot out of the consistent growth stocks, especially tech stocks like software and semis that don't benefit from the rate cuts. They have to then swap into the companies that can supercharge their earnings as the Fed takes rates lower. We all recognize that the cyclical stocks, the ones that benefit from lower interest rates, can go higher, maybe much higher. What's painful for many of you are the declines in stocks of companies with consistent earnings.
The house of pain.
The companies that don't really need lower rates, the tech companies in particular. They're selling off as though money managers need to raise capital in order to rotate into the rate cut winners. So why don't we do this? Let's go over the winners and talk about the losers. The rate cut winners are divided into two camps, the stocks with high dividend yields and the cyclical companies with earnings that should go higher because lower rates will bolster all sorts of industries, especially housing. Let's start with the most direct beneficiaries. Let's start with housing. They were all down today, and I think that's because the hedge funds and mutual funds bought these stocks aggressively ahead of Friday's Jackson Hole verdict. The mutual funds are staying long. That's what they do. But the hedge funds, they are ringing the register furiously. I mean, they're going crazy because they've made so much money. The housing stocks have had parabolic moves going to the Fed confab at Jackson Hole. So now these portfolio managers are just taking the profits. By the way, that's what you're supposed to do for a successful trade if you are a trader. Remember, these guys were always traders, not investors. So the housing trade's over, but how about the housing investment? Look, I believe the Toll Brothers, which just reported a stellar quarter last week, can go higher, maybe much higher. But this reversal is going to constrain the stock because people do not like these technical trends that we just saw. We've seen multiple long-term reversals after these kinds of moves, and they rarely turn out to be buyable, even though in theory this should be a great moment for the stock of all the home builders. It doesn't matter, though. This kind of reversal that I'm talking about in Toll or D.R. Lenore, they can be hideous. Some are very close to their highs. I don't like that. Those who have these, well, you can hold them, but they flew too close to the sun for getting new buyers in. Remember, I've said all along that by the time the Fed gives the all clear, it may be too late to buy the most obvious rate cut winners. You have to let them recharge, let them come down, and then you can pull the trigger. Then there, of course, there are the ancillary plays. There's Home Depot and everything that goes in one. Every single aisle of Home Depot could be a buy. Home Depot itself is a stock we're considering for the Charitable Trust, which you can follow by joining the CNBC Investing Club. Sometimes you can't overthink things. When you're on the quarterly Home Depot conference call, it's largely devoted to the damper that high rates have put on sales. It was really kind of a bummer, frankly. Then you know that the interest rate headwind is about to turn into a tailwind, and you have to be a buyer. Hence our desire to pick up some for the trust. Lowe's is in the same boat. I like them both very much now that we're going to be sure that the Fed is going to cut. I like them as much as I didn't like them 2 weeks ago when it looked like the Fed might not. Now, some stocks have had such mammoth runs that you don't want to have your money languish. Sherwin-Williams, good example. The paint company is recommended almost every day. This one is due for a pullback. We own Stanley Black & Decker for the trust, and it's been a bit of a coiled spring. That said, it's had a nice run from the bottom, and its yield is just 3 and change, much lower than where it was before, like when the rally got going. I mean, what can I say? We sold a little. I think it can go higher, or we would have sold it all. Warehouse is a much easier call. Its stock seems very unloved here at $31. Even this will desperately need their lumber if the rate cuts come fast and furious. Please do not forget a company we showed you last week. That's Fortune Brands Innovations. This maker of highest-end faucets and housing accoutrements, including decking and safety, can really benefit from lower rates, even as it's done a lot of self-help to thrive in a high-rate environment. I really like that shut-off device that they can prevent flooding when you're away. Insurers are embracing the concept, giving you lower homeowners premiums if you buy these setups. They pay for themselves. If you get a serious run in housing, then Master Brand, formerly part of Fortune Brands, could really be good. It's maker of cabinets. We've used the Aristocrat cabinets. They're fine. But my favorite in this group may be AZEK. Yes, the faux wood products company that's fantastic as a replacement for wood decking and trim. I put a ASIC in the moment I buy a house because I'm tired of having to fix a wooden deck 2 or 3 times. Real wood is a money pit. In a few years, you just don't even realize how much of a difference you can save. ASIC has leaned into recycling, and it's a big percentage of it is materials that are 90% recycled. By the way, I think Owens Corning has great fiberglass for housing. That's pulled back a little. One of my favorites, though, is DuPont, double D, which is splitting into 3 companies, of which one, classic DuPont, has Tyvek, the obvious housing play. The trust owns it, and I think it could rally much further, especially if it gets bids for its water division, which is technically for sale. The more attenuated plays are going to work too. Caterpillar, you saw that up today. Martin Marietta Materials represent the basics of building out new housing developments. But those really start winning later on, once the home builders fully embrace new construction. Oh, and one more that's not for the squeamish. Whirlpool, serial disappointer that may or may not be able to bottom. We might need a raft of cuts to boost that one. I put Williams-Sonoma and Wafer in the same category, but they just reported, and they didn't give me much to hang my hat on. RH, the old restoration hardware, it isn't much different. A lot of things have to go right to get that one moving. Those are the most straightforward potential winners, but the other side of the rate cut is to search for stocks with larger yields that can become bond market alternatives as rates come down. Buyers are already embracing Johnson & Johnson, which has the added advantage of a weak dollar. Dollar's been very weak, so it's twice blessed. Kimberly-Clark, again, failed to beat the estimates, so it stalled. But I think it's just a matter of time. I also like the oil and gas pipelines. More on those later. Now, how about the other side of the trade, the sources of funds? This one's really tricky because right now the best are being thrown out with the worst. The semis are horrendous. I am gratified NVIDIA is coming down ahead of earnings on Wednesday, though. It needs to pull back here if you want to see it rally on results. I like Amazon, the possibility of knowing exactly what you want before you even thought of it. That's the next frontier. If Amazon can find a way to batch every same-day purchase, I think it can save a fortune. Meta, it's killing it, but its stock is down 23 points from its high. I like that. I like AMD. It's a worthy second NVIDIA, but it's not going to. The stock's really, really tough sledding here. Micron's down a great deal. There's plenty of need for high bandwidth memory. All of tech is for sale. Apple now is for sale because its fabulous CFO, Luca Maestri, is going to be stepping down, but he's going to stay for a while, so let's not panic, please. But the bottom line, I want to keep the buy list small because I think there'll be many more days like this to come. There's just not enough money raised so far to think the tech has bottomed. The sales are not covering the buys. At this point, there's going to be a lot more NASDAQ weakness. So please be ready to do some buying, but just not yet. Too early in the rotation. I want to go to Thomas in Wisconsin. Thomas.
Hey there, Jim. Always appreciative of your insights and your preparation.
Oh, you're very kind, Thomas. Very kind.
Oh, you're great. Back in 2019, before the pandemic, I was introduced to Moderna through your show and bought it at about $20 per share. I've sold most of my position off when it was higher, but now it's less than 1/5 of its all-time high and down over 25% year-to-date. Is this a buying opportunity, or should I give it more time?
What a tough call. I've got to tell you that it keeps... Let's put it this way. It's not delivering what I expected at this point would be personal cancer vaccines. I think you can still fall some because it's not making any money. That's my take. Let's go to Har in Virginia. Har.
Hi, Jim. How are you doing? Thank you for your time.
I'm doing well. Thank you. Thank you. How are you doing?
I'm good, thank you. Thank you for all you do for us to teach us about investing.
Terrific.
My question was about ZM, Zoom Video Communications, who just reported earnings. It wasn't too bad of a report, in my opinion. The company's balance sheet looks pretty clean, no long-term debt. 30% of the market cap is cash and marketable securities. For the fiscal first half of 2025, they are reporting a free cash flow of $925 million. The revenue growth was 2%, unlike the pandemic time, but the enterprise client contributing to more than $100,000 grew by 7%. And it's trading at a fairly cheap valuation, in my opinion, with 8 times forward.
Boy, are you ever right, Har. You are right. I liked the quarter. I thought it was a good one. I like this. There are many, let's say, accoutrements are starting to work for Zoom. So a lot of things that they develop, including some of the apps. I think it's a good buy here. Now, it just had a parabolic move off the bottom. Straight line. It can measure. It can probably, like, churn a little bit here. But I agree with you. I think Zoom's really interesting. This was a very good quarter. How about Faluk in New Jersey? Faluk.
Hi, Jim. How are you doing?
I am doing well. How about you?
I'm doing good. Thank you. This is Falak from New Jersey. I've been following your show for many years, and I really appreciate all the effort you put into helping people make informed investment decisions. Thank you so much for that.
Oh, thank you.
My question is about Uber. They had great results last quarter, and the stock spikes up afterward. Given Uber's market cap and the current market turmoil, should I consider entering now, or would it be wiser to wait for a pullback?
No, I actually buy some Uber here and then wait for a little bit of a pullback. Uber's doing incredibly well. You may not get that pullback, so I want you to get some on the sheets as we talk about it. It is up a lot this month, so let's be careful and only buy some, not all. And thanks for the kind words. Okay, look, there's going to be more NASDAQ weakness, especially when rates start coming down. People keep shifting the money toward the groups I just told you. So you have to be ready to do some buying, but not yet. On My Money tonight, after his bullseye quarter last week, can we officially declare a turnaround in Target? I'm breaking down the numbers behind the retailers report and telling you where I stand. Then from energy to real estate, I'm laying out some high yielders that you may want to add to your watch list. Plus, could cooling interest rates open the window for HVAC stocks to heat up? I'll reveal my picks, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.